Billionaire Chamath brutally defends Palantir after Michael Burry's short. This is a must watch.
I guess the other short we should take a look at is the Palantir one, because Palantir is, man, it's way out there. Alex Karp has been doing some great interviews. He's a national treasure, incredibly entertaining. They obviously have a great business. They're on a $3.5 billion run rate, according to their last quarter. But the valuation is $480 billion. This puts them at 137 times their sales. It is extraordinary. It's way out there. Datadog and Snowflake, Microsoft, these are at 13 times their sales. And I guess Cloudflare is out there at 37 and CrowdStrike at 30. So this is truly an outlier, Friedberg. If you were to give Palantir the same price to sales ratio as some of those highly valued ones, probably be a $60-70 billion company, $29 a share instead of 170. So what do you think of his Palantir short, Friedberg?
Based on the statement you just made, you're saying that a company is worth their historical sales numbers. And I don't think that that's how shareholders often do, or perhaps should think about what they're buying, which is an ownership interest in the future of the enterprise that they're buying a piece of. When you invest in a startup, you're not saying, hey, that startup is worth what the employees did last year before they even started the company. You're making a bet on the future potential of the business and what you think the cash generation over time will be. Your time horizon may be different than mine, and that's how a market finds a price. As a result, I think there's probably a market trying to find a price for Palantir where folks have a great deal of difference in opinion over what the future potential of the business is. And as a result, what the earnings generation will be at different timescales in the future. And that's how they're getting to the current market price. Who am I to judge? I am the person who would make my own decision of my own timescale and my own estimation of the future of that business if I were putting my own capital into the business. I've not studied the business well. I don't have a strong point of view or opinion on the value of the business relative to its future earnings potential. That's how I would look at it. I would make an investment for the long term if I were to buy the shares, not look at the last year's numbers and say that there's a valuation arbitrage opportunity and that's what I'm buying. So, to each their own. Over time, the market corrects itself. As they say, it's a voting matter today and it's a weighing matter in the future. That's Warren Buffett's famous quote, that the actual earnings generation in the future will determine whether someone paid a good price or a bad price, depending on the point at which they bought in the past. Meaning, at 400 billion market cap, you could be getting a steal, or you could be significantly overpaying. That's going to be based on your assessment, your judgment as an investor.
Yeah. And I think people are looking at like 30 to 45% year over year growth, Chamath, and saying, yeah, it's got a lot of, to fill in that valuation would just take a lot of growth. Maybe the growth accelerates. We saw that with NVIDIA, right? They started to have unprecedented growth. Any thoughts on Palantir short while we move on to our next subject, Chamath?
Well, I think the Palantir short is stupid. And I think that those people will lose money. The thing with all of these other companies, put your chart up there. The thing that the people that are shorting this company don't understand is that all of these other businesses that you put up there is a viable competitor of some kind that you can switch to. And so what I would say is the opposite of what they're saying, which is you have a low multiple to sales when the churn risk is higher. So look at the one with the lowest multiple to sales, MongoDB. There's 90 versions of what MongoDB does. I'm not going to say whether MongoDB is good or bad. That's actually a good company. It's an extremely well-run business. But it's not unique. It's just extremely well-run. Snowflake is not unique, but it is well-run. Palantir is both unique and well-run. And there's no clear alternative, so there's no place to churn to. And so I think the reason why it has a premium valuation is because the duration and the durability of these cash flows are much longer than what you typically see in any of these other companies. And if people took 1/1000th of a second to actually use their brain, they'd come to that conclusion.
Lack of competitors would be the reason you think it's more defensible. Yeah.
By the way, I'm neither long nor short. I was long in the private markets. I was an investor in the Series B of Palantir. I'm not long anymore. I wish I was, but I'm not. So it's not like I have a vested interest in this being right, but it's just so obvious that what they do is completely unique and completely differentiated. There is no alternative in the market for it. That's why they trade at such a huge premium to sales. And if you look at any market for any product that is unique and is effectively where they are the only competitor for what they offer, you will see an equivalent market dynamic like this.
Palantir trading at around 130 times sales, while competitors are trading at 13 to 30 times, but Chamath argues the short is stupid because Palantir is completely unique with no viable alternatives. When there's nowhere to churn to, cash flows are far more durable, justifying premium valuations. Chamath declares that the Palantir short is stupid and that those people will lose money because all of the other businesses out there being compared to Palantir, there's viable competition of some kind that you can switch to. And the reason that Palantir has a premium is because of the duration and durability of Palantir's cash flows are much longer than what you typically see in most other companies. I think this is a fundamental misunderstanding of the people shorting Palantir based alone on traditional valuation metrics. They're applying software as a service comps to a company that isn't really SaaS in a traditional sense. Standard enterprise software has commoditized competition. You don't like Snowflake's pricing? Switch to Databricks. The switching costs are real but manageable. Palantir operates in a completely different category. What they do, integrating disparate data sources, building ontologies that map complex organizational knowledge, deploying AI that actually changes battlefield outcomes or manufacturing margins, has no equivalent alternative. You can't swap Palantir for another vendor because there's no other vendor doing what they do at their level. So the no place to churn to point is critical for understanding the durability of Palantir's cash flow. Traditional enterprise software lives with constant churn risk. Salesforce knows every customer is evaluating competition. That competitive pressure limits pricing power and creates customer acquisition costs as you replace churned customers. But if customers literally can't leave you because alternatives don't exist, your revenue is far more protected in the long term. Think about what this means for a defense contractor using Palantir. They've integrated Palantir into their intelligence workflows, trained analysts on the platform, built custom ontologies mapping their operational data. Switching would mean rebuilding all of that infrastructure with what exactly? There's no competitor offering equivalent capability. So they're locked in not by contracts, but by the absence of alternatives. And that is the strongest moat in enterprise software. But the uniqueness is just one layer of Palantir's defensibility. Palantir has built multiple compounding moats. The complexity of their ontology platform creates switching costs. Their government security clearances take years to replicate. And the AI that works versus AI that doesn't divide positions them in a high value subset of the market that competitors can't easily enter. Drawing from a previous Karp interview, he defined two AI markets: the large market of AI to do basic things that are not sophisticated enough to change your revenue or margins, versus the subset where you can show quantifiable results that change the battlefield results or your margins or revenue. Chamath reinforced this, calling Palantir completely unique, and again explaining customers have no place to churn to because what Palantir delivers has no market alternative. Palantir's moat is about having structural advantages that make competition extremely difficult, even if they are well-funded competitors who want to enter the space. Palantir's ontology moat is a deep technical barrier. Palantir doesn't just provide software, they build custom knowledge graphs that map organizations' entire data landscape and operational logic. For a defense agency, that might mean integrating 50 plus data sources, understanding relationships between entities, and encoding domain expertise into the system. Building that ontology takes 12 to 18 months of intensive work with subject matter experts. Even if a competitor offered equivalent software, the customer would need to rebuild that entire knowledge structure from scratch. The switching cost is measured in years of lost productivity. And then we have Palantir's government security clearance, and that one is underappreciated. Palantir has deep relationships with intelligence agencies and defense departments requiring top secret clearances. Their engineers have those clearances and understand classified requirements. A new competitor would need years to get personnel cleared, build trusted relationship with procurement officers, and their security posture meets classified standards. So this isn't a technical moat, it's a regulatory and trust moat that time and money alone can't quickly overcome. And then of course the key point that Palantir is selling AI that actually works. Most AI vendors are selling productivity tools and chatbots. Palantir's quantifiable outcomes in life or death and high-stake business environments. That requires completely different go-to-market implementation, methodology, and product architecture. Competitors focused on the large productivity AI market can't easily pivot to the outcome-based AI market because the skill sets and approaches are fundamentally different. The data network effect compounds over time. Every Palantir deployment generates insights about what works in that domain, be it manufacturing, defense, healthcare, energy. That operational knowledge feeds back into improving the platform for all customers. A competitor starting from zero doesn't just lack the software, they lack the accumulated learning from thousands of deployments about what patterns matter and how to solve specific problems. Palantir attracts engineers who want to work on hard, meaningful problems: national security, saving lives, transforming industries. That mission-driven culture is hard to replicate at a generic enterprise software company. The best engineers in this space want to work at Palantir because that's where the most interesting problems are solved. Competitors trying to build equivalent capabilities face an uphill battle recruiting comparable talent. Palantir's forward deploys engineers work on site with customers for months or years, becoming embedded in their operations. They understand the customer's problems better than the customer does sometimes. That deep contextual knowledge creates dependency. Customers rely on Palantir not just for software, but for operational expertise. And importantly, these moats compound over time. The ontology complexity plus government clearance plus outcome-based positioning plus data networks plus data network effects plus talent advantages create a defensive position that's nearly impossible to match. A competitor would need to overcome all of these simultaneously, which is why after 20 plus years, Palantir still has no true head-to-head competitor. For many, this explains a 130 times sales multiple and why it may be reasonable. Of course, that's not financial advice from me. Some think if these moats protect 30 to 45% annual growth for the next 5 to 7 years with minimal churn, those cash flows could validate today's valuation. But what's key to understand is the market isn't pricing historical performance, it's pricing a decade of compounding growth with structural protection that doesn't exist for companies trading at 13 times sales, that doesn't exist for the other companies Chamath listed. Most people pour money into ads people ignore. YouTube changes that. It builds trust, authority, and a real connection at scale. One law firm we worked with landed 33 clients in just 5 months worth $330,000 from their YouTube channel. If you run a business, this is one of the most overlooked opportunities right now. Book a call with me below and I can show you how we can make it happen.